Okay, we're on. John, listen, man, welcome. I think this is going to be exciting. This is the first podcast we're doing. If you're listening, we're going to talk all things EM because EM really is what happens every single day. I mean, every day there's news, whether it's Russia, China, and North Korea getting together, the U.S. blowing up boats and Venezuelan ships, Brazil locking up potential presidents, the Middle East. I mean, this is all emerging markets, right? I mean, the U.S. is, to me, the U.S. is a sideshow, John, don't you think?
Yeah, and emerging markets. I think they may be coming back after a long period of darkness. Almost 13 years, 14 years of terrible performance. And all of a sudden, the horizon looks a little bit better. So hopefully, part of that is just the weakness of the U.S. and what's going on in the U.S. But others, just maybe it's just part of a long cycle. You had a long down cycle, and maybe you'll have a nice up cycle in emerging markets.
Yeah. I mean, hopefully most of the people know who we are a little bit, at least. But I think just a brief, I mean, both of us have had long careers. I mean, you spent your whole career on the buy side, working at Alliance for a long time, then the Abu Dhabi Investment Fund. I was on the sell side for a number of years, and on the buy side, and now I'm involved in something completely different in AI. But I think what we're going to try to do is bring on, instead of you guys hearing us chat, which we can do, but bring on people that have been involved in emerging markets, either from the standpoint of working for investment banks, working for companies, strategists, everything that relates to EM, to give insights on what's going on around the world from an EM perspective. Because as you mentioned, John, I think that when you look at gold, the price of gold going up and hitting new highs, it just tells you the U.S. market is keeping up, but it can't hold. Like the earnings power just isn't there, and the U.S. dollar is just in the beginnings, I think, of a long slide. I mean, do you feel as strongly about that as I do?
Yeah. I'm not sure, what's going to happen, specifically to any one asset. But the fact is that we are in a period of great turbulence, and so many things are starting to happen. They will accelerate, and EM is just a big part of that. It's going to become a really center of it because China is so important, and the whole world is trying to adjust to this new situation. What we see over the past couple of weeks has just been amazing with what's going on with India and the way that President Trump has managed to alienate India through his policies, and all the implications of this in a turbulent world is very interesting, and that's what we'll be exploring in these chats.
Yeah, I mean, the interesting thing is that, I mean, no matter what the news that comes out of Washington every day, there's an EM tint to it, right? So yesterday was the get together of the last couple of days of China and Russia, and the big parade, and they had North Korean guy. Then Modi came over. Lula even called in on a Zoom call, which is kind of funny at the end of the day. And it is pointing to, and look, I'm an America First guy, but I'm also a realist that if I was the premier of China and India and other places like Brazil and Russia to a certain extent, I would be looking at alternatives. And certainly with the amount of central bank gold buying, and it's just beginning, right? If you look at the percentage of gold reserves, there's a huge amount of buying power left to diversify away from the US dollar. And eventually gold's going to get to the point where people are going to look for other things, meaning other metals, commodities, right? I mean, I know you're bullish on commodities, but I think that's where we're moving, right? They haven't even
Yeah,
begun to move yet.
that's a big part of the story for emerging markets. Is if we're going into a cycle of dollar weakness, and if you measure things in gold, it's completely different than you measure it in dollars. And if this dollar weakness continues, and then commodity prices will do very well, and then that brings back so many of these emerging markets, that brings them back to the fore. And all of this in an environment of chaos where, Trump has decided that the global order is terrible. He wants to reshape it. At the same time, the U.S. has basically alienated itself because it's taken a very unilateral position towards all of the policies it's trying to implement. And that just leaves so much room for Xi to forward his policies. And then countries like India and Brazil that are important countries, very significant. They, who knows in what direction they're going to go. It's a big question. So what is this new world order that it seems like everybody's decided they don't like the order. But then what replaces it? Is it no longer U.S. centric? Is it completely multilateral? We have no idea today. All of this is going to be played out over the next 3, 4, 5 years in an environment where finances are likely to be very complicated because of the debt situation in so many countries, not only in the U.S., but look at what's going on in Europe with France and the UK. And a lot of emerging market countries have a lot of debt. Brazil is very indebted. All of this is coming to a boil. It's all going to play out very quickly in an environment of financial instability and moving towards like a new global monetary system and a new world order. There are a lot of questions marks, and who knows where this is going to end up. It can go in many different ways.
Yeah, and the investment implications. So if you've been a U.S. investor in the S&P 500 for the last 25 years, it's been amazing. The compounding at close to 20%, which is unprecedented for this period of time. And then since COVID, it's been incredible, right? I think the S&P has had, even with the down market in 2022, it's been over 20%. I mean, it's just crazy. The movement, and for me, it's always been, this is the first time where I think an index is meaningless, right? Stock indexes are usually a forward indicator for economies. I think the S&P 500 is a worthless instrument. It doesn't give you any indications of the U.S. economy, and because I think there's just no liquidity in anything, and something's going to hit the fan, because as we're seeing, then we always, looking back at careers, we looked at the economic numbers coming out of China, we would laugh, oh, they're not realistic, in Brazil. And now the U.S. has become an emerging market in terms of economic numbers. They're not believable. They haven't been believable for a very long time, mainly because the participant rates in the surveys are so low. So it's meaningless when only 30% of the people you're participating, of 350 million people, you're talking to 10,000 people, and all of a sudden that's the core of a number. It's meaningless. So, and now it's even worse because the government is taken over, and maybe they'll change the system. The only hope is that they'll change the system of how these surveys are done. But the U.S. is an emerging market when it comes to the economic numbers.
Yeah, it's funny you say that, because it's become it's something you hear in the hedge fund crowd a lot these days, and that is it's the quote is, "We're all Brazilians now."
Yeah.
And I've heard this from many people. That the U.S. it feels more like Brazil, right? We have fiscal dominance here, which Brazil has had on and off forever. We have sort of unstable government and lack of respect for institutions and rule of law being questioned. And we have a major debt crisis, which is going to have to be resolved in one way or another, but with some kind of pain that will be that that will be felt by someone, right? I mean, the whole decision is going to be who's going to feel the pain, and it could be financial markets this time. Maybe it will be Wall Street. So who knows?
Yeah, and it's funny, and we're running at like, I don't know, $2.3 trillion deficit. Imagine if, I mean, think about emerging markets back in our day in the late 90s. We had the Asian crisis, we had Brazil default, we had Argentina default, Russia default, and they were running the same type of deficits. And these, the budgets, for example, of the last 12 months. The French government fell because of budgets. The UK government changed because of budgets. Germany because of Italy because of budgets. And here we are, the US, with the worst situation you could imagine in terms of budget and deficits, and nothing's changed. Shocking.
Yeah, what you do see is you see the rise of Bitcoin and gold, and people are definitely starting to hedge themselves. These. All these different cryptocurrencies and so forth. It's just remarkable how much volume is going on to these things. And basically there are ways to hedge, hedge against the dollar and hedge against the US ability to control capital flows. And so, yeah, you see so many signs of changes happening. And the question is how quickly will things happen? Things can happen very slowly, and then all of a sudden very fast, and we will see.
Yeah, one of these days I have someone we can bring on to talk about stablecoin. Just wrote a really interesting paper, an academic, and I think this stablecoin phenomenon that is going on today is going to have incredible implications for the U.S. and the world. And all right, so I think our first guest is arriving, Jean. So let's bring him in. Our old friend, Geoffrey Dennis. Geoff, how are you? You are live with Tom and Jean.
How are you? How are you, John?
Hi, Geoff. It's great to see you.
Everybody's looking good, I think, by all accounts. So anyway, sorry if I was a moment or two late.
No. We were just chit-chatting, Geoff. You're our first guest, so congratulations. You're the only guy we could have thought to have as our first guest.
I'm a little intimidated, but I'm very happy as well.
Well, listen, Geoff, I'm going to embarrass you by giving a little bio for those who don't know you. It would be shock to people that don't know you, but I'll give a little bio, and then we'll just fire away. So, Geoff, again, thanks for coming. You're retired, but you call yourself now an independent emerging markets commentator. But I'm going to call you an award-winning EM strategist. I think people will realize that from your voice, you are from the UK. And by the way, Geoff, we're going to talk about the UK for a few minutes at some point, because it's shocking what's going on there. But forgetting about that, you earned your degree at University of Durham, master's in economics from the University of Warwick in the UK. And then you started your career at BIS, the Bank for International Settlements, very interesting there. And then you started your very long career on Wall Street at places like James Capel, which, by the way, for those who know James Capel, it was the first real emerging market investment bank research company that really took a focus on EM. So you're definitely a pioneer. Then you became LATAM strategist. That's when we met at Bear Stearns. We were colleagues for a very long time. You had a long stretch at Citibank as their global emerging market strategist, head of Latin American research. You joined UBS in 2013, head of global emerging market strategy. And then from there, obviously, you retired. And I'm exhausted from talking about, but you are a very well-known, for those in the capital markets, you're a very well-known guy. You've been someone that people like to speak to. And I could tell you from experience, you are one of the hardest working guys I've ever been associated with. So I just want to say that. So anyway, after all that, Geoff, thank you for appearing.
Thank you.
Jean, let's start off. Jess, give us your big picture view on EM, and then we'll just dive in from there.
Well, I think the way to look at EM in 2025 is that, and I did some serious thinking about the way I wanted to present this before we did the recording, is that I think most people got EM wrong this year. and I certainly did at the beginning, because the expectation was that Trump's tariffs would be a big driver, and they would lead to higher inflation, potentially higher interest rates in the US, and certainly no rate cuts, although we haven't had any this year yet, although we're going to get some, especially after today's payroll employment report. And that would lead to the dollar going stronger. Now, you both know that one of my big themes all the way along the line has been a weak dollar helps EM because it sucks money out of the US and pushes it towards yield and risk, etc. In the emerging markets. And therefore, my thought was that if the dollar's going up here, and I at one point, rather embarrassingly, talked about a potential test of euro dollar at one, at parity. If that was going to happen, that would not be good for EM, or at least it wouldn't be very good for EM relative to DM. Now, I think what happened to change that whole narrative was the sheer scale of the tariffs that President Trump has brought in, or at least that he threatened to bring in. And of course, we've had a new piece of news on this pretty much every day. And in particular, the big event, so to speak, or the big period where this narrative really changed was early in April with so-called reciprocal tariffs and President Trump's, board that he held up in the White House listing all these tariffs. And there was just panic in the US markets for a period of time. Equities down, bonds down, and the dollar down. And the dollar's been going down ever since. And that really brought the whole issue of, do I want to invest in the US or do I want to invest somewhere else into play for 2025? And of course, for a long time, there was a lot of excitement about Europe as well, although a lot of that has subsided now. So on the back of that, EM suddenly took off. We also saw another strong performance specifically by China this year, which is still around 30% of the index, and has played a significant role, of course, in the overall rise in the index. But EM has done very well. It's up around 19% as we speak in dollar terms. DM's up about 14%. And so equities have done better than I would have thought would be the case. And EM has been in the lead, and that's been driven by, as I say, some distinct doubt about what is going on with respect to the US. So that would be my big picture outlook. Now, if I can just, big picture analysis of what's happened. The outlook, I think, from here is so unpredictable because we don't know what's going to happen with US monetary policy. We don't know what's going to happen with US fiscal policy, although I'll give you my views about that. And we certainly don't want to know, we don't know what's going to happen with tariffs on countries, particularly such as India, which has been whacked with huge tariffs, Brazil, of course, for largely political reasons. But my sense here is that the dollar, which is only from its recent peak, 40% down from the rally it took from mid-2000s to the peak a couple of years ago, it's only 40% down. The dollar's going lower still, I think, over time. And if that is true, I think the general outlook for emerging markets is pretty good. And I would expect to see EM continuing to outperform DM for a period of time against this background, with the caveat that what stops this immediately is should everyone become so bullish about the US again for whatever reason that we start to see a big flood of money back into US assets, which of course could happen. And if it goes back into the dollar, well, that's going to be specifically a challenge for the US. But sorry, for emerging markets. But that's where I would stand right now.
Geoff, it's not really clear to me what's happening with flows. The data that I've seen shows, a lot of foreign money continuing to flow into the stock market, in particular, and so that would not. You would expect eventually, if that money starts flowing out, that could be a big problem for the dollar, but it doesn't seem to be happening yet. So, how do you see flows? Do you think that there are outflows in other areas, or is it perhaps, what is the explanation for this weak dollar? We know that this administration is more amenable to a weak dollar than any previous administration. Could that be part of the reason, or what other explanations do you have for a weak dollar?
I think that's part of it, frankly, and I think it's a number of issues. I think, in particular, it's the perceived challenge, rightly or wrongly, to the Fed's independence, which is a whole separate story, I'm sure. With obviously the pressure on Lisa Cook, with Stephen Moran going on the board almost certainly, with the pressure on Powell himself, with the fact that we're going to get 25, maybe 50 next time, which Trump will undoubtedly claim credit, but he'll still be disappointed. So I think the uncertainty over, this long cherished independence of the Federal Reserve is a factor here in the weak dollar. But I think the other thing I think is worth pointing out is that it's not just a valuation story, but we could certainly discuss that. But EM has underperformed for so long that I think a lot of investors globally were so top heavy in the US, and indeed that had made perfect sense. It had worked very, very well. That when it came to slightly better conditions for EM, you suddenly got this move back in. I don't think the flows, and I don't see the flows data on a regular basis anymore. I think the flows have been significant going back into EM. And if you look at the Bank of America survey, ostensibly, the investors being surveyed would indicate that they're making their biggest move into EM that they've done, for years and years. And so I think there is money coming back. But I think it's the question of what's the cart and what's the horse here, because then the dollar is the driver, and it's the flow response that we come to it. I've never been a big believer that valuations drive markets on their own. They need a trigger. Or triggers. And EM has been cheap relative to DM for many years, since really the end of the 2002-2007 so-called commodity supercycle phase. And I just looked at the valuations put to MSCI at the end of August, and EM is trading on a forward PE basis, if you believe any of the data there, at a 35% discount to the developed world and a 47% discount on price to book. But that's not enough. You've got to have a change in something else triggering the flows. The flows have now been triggered, I think, partly by the drop in the dollar and the uncertainty over US policy generally. We have to talk about US fiscal policy, which I think is under a lot of pressure. And I think that's probably in its early stages, the flow move. But I'm unclear how you back that up with actual facts. All I know is that investors have turned much more bullish, and whether they've moved all the money they're going to move, I somewhat doubt. But I think that's probably the way you look at the story.
Yeah, but it's interesting that Moran is quite a controversial figure in the sense that he published that report, on that policy report, recommending eventually capital controls on international investments in the U.S. Mm-hmm. And that seems like a weird appointment to the Fed. Do you think that may be part of the reason? So maybe it's just more money leaving fixed income rather than equities. People are more comfortable in equities because of the quality of the assets and the protection they may have against turbulence, but they may be taking money out of fixed income instruments.
And I think the equity story is very interesting because clearly the gap in performance between EM and DM so far this year has stabilized. If anything, it's pulled in a little bit. EM is outperforming DM by about 500 basis points now. EM's about 19%, DM up about 14%. And that's stabilized, I think, because of this, tremendous excitement, which I will admit I don't fully understand. Not that I don't understand the excitement. I don't understand, so much behind it, but of artificial intelligence and those companies that are in the lead there. And I think that's turned the April situation almost around full circle, saying, okay, we had this extraordinary period where everyone was dumping US assets because of what was going on with tariff policy and other things potentially. And now suddenly, people are putting money back into the US, many highs in the S&P this year, not as many as I think last year, but still a lot of highs. because the US, albeit, with China as a rival, is so much in the lead as far as AI is concerned. And of course, it's leading to dramatic increases in investment going forward, which is also encouraging investors to come back into equities, as well as or to continue to invest in equities, and is also, of course, leading to a situation where, you have got some support for the economy in an environment where obviously the labor market is suddenly weakened fairly dramatically. I'm getting very short term here. Now, since, of course, again, April, and since the market settled down, you've seen, and particularly recently, you've seen both bonds and equities rallying. And I suspect what happened is maybe after April, a lot of movement out of equities, some in the US, some of that's come back in again. And bonds, of course, are being boosted by the soft labor market, and therefore the Fed's going to cut rates, etc. And everyone, rightly or wrongly, and I'm sure it's probably to a certain extent wrongly, are pretty sanguine about the inflation story, at least for a period of time. And I think that's also what's going on. As far as Moran is concerned, I think one interesting theme there is that depends what you call capital controls. Of course, we as emerging market people should be experts on capital controls. But the IMF for many, many years was against capital controls. Malaysia introduced them in the middle of the Asian crisis in 1998 or early 1999 and got blown out of the MSCI EM index. Russia, after they invaded Ukraine, introduced capital controls. They got blown out. Argentina, that's happened on almost multiple occasions. But now the IMF has certainly argued, and I think there's something to be said for this, that under certain conditions, Michael Pettis has said this as well out of, I think he's in Hong Kong, maybe he's in China. You'll know that more than I do, Sean. I think he's in China. Michael Pettis has said the same thing. Under certain conditions, capital controls are a good thing. Now, if that's what Stephen Moran means, okay, depends what those conditions are. But if what he means is that foreign capital coming into the US is going to be taxed, which of course has been discussed, let's say a 10% rate or whatever, that is a massive, massive negative, I think, for investment that flows into the US and would be a clear factor producing yet more weakness of the US dollar. But gosh, you never know. You never say never about anything these days, but I would be very surprised if that's what comes out of this.
And we also have the possibility of our old friend David Malpass joining the Fed.
Yes.
And given that you and I work with him and you know him better than I do, what would be an implication of Malpass either taking over from Powell or even one of the Fed governors? I mean, given his, what do you think? Because that's something that's been talked about.
I'd be surprised if he becomes the Fed chair. I doubt that's going to happen. I think more likely it's going to be Waller, most likely, or the other guy whose name I've forgotten, the supervision guy, forgive me, Kevin Walsh. But if he went on the committee, he wouldn't become a governor because no one's going to have him, I think, as a regional reserve governor. He would be, well, first of all, the way I always viewed David, and we clashed a little bit about this, obviously, in when we were at Bear, the way I always thought David, with respect to emerging markets, and we need to broaden that out, is that he was always a fixed exchange rate guy. And I learned as a result of Mexico in 95 and Asia in 97 and Russia in 98 and Brazil in 99 and Argentina in 2001, is that fixed exchanges are fine until they're not fine. And if you aren't running consistent policies to keep those exchange rates stable, the blow up of the peg or the pegs is going to be much, much more painful than having what we have now, which is nearly every country. China's obviously different. Nearly every country following a floating exchange rate regime, and then you can lean into the inflows or the outflows without it leading to a blow up of the whole exchange rate system that this country is following. Now, that's maybe not so relevant with respect to what Malpass could do at the Fed, but I think what David would really pursue would be, given that he's totally signed up, I think, to the sort of Donald Trump views of the world, is he would very much follow the value of imposing tariffs, the money that can be raised for tariffs, which could have some impact on the budget deficit, which is true on what should we call it? It's only one part of the issue as far as I'm concerned. I'd be very surprised though, and if I'm wrong here, I would have misjudged him badly, but I'd be very surprised if he would be happy to compromise the Fed's independence. So I view him as a trumper on tariff policy, a fixed exchange rate guy generally, but mainly to do with emerging markets. I think he was a not unsuccessful head of the World Bank. But as I say, I think he's just going to be, if he goes on the board, it's going to be just one vote. I doubt he'll become the chair. And I think he would have a very interesting and probably quite challenging confirmation process in the Senate.
So, Geoff, I think the debate with the Fed is not so much about independence, but rather what kind of ideology they will pursue. Mm-hmm. Perhaps moving from a extremely mainstream neo-Keynesian kind of framework that they've used for the past 30 years mm-hmm. to what Scott Bessent would call a pro-growth framework. Mm-hmm. Mm-hmm. How do you see that? And Malpass, I presume, would fit in nicely in that, wouldn't he?
Yes, he would. No doubt about that. I think one thing to say with respect to that is that it's not difficult to argue that the two the dual mandates, so-called, of the Fed, as initially enshrined in the Humphrey Hawkins Act of the late 70s of low unemployment, or at least, I don't know the exact wording, but obviously looking at the real economy and controlling inflation, it would be easy to imagine that could be, gradually stepped away from, although Congress would have some views on that for sure. I think the other part of it is to what extent the Fed is going to react in a conventional manner or an unconventional manner to one of the other consequences of the pro-growth policies which this administration is following, which is this extraordinary, in my opinion, expansion of fiscal policy in a way that I think does threaten sharply higher budget deficits over time, and indeed a continuing rise in the debt to GDP ratio. In other words, you've already seen the pro-growth mentality, or the pro-growth priorities of this administration. You haven't particularly yet seen that translate into the Fed. Now, I think that would happen once Powell goes, once we get a new chairman, and once we get potentially, a couple of 2 or 3 more committee members, especially if Lisa Cook is ultimately forced off, and Moran is on there for a period of time. Maybe Malcolm Balmas could be on then. I think the only risks with that would be twofold. Number one is, you can't forever, at least I don't think you can, destroy, let's use that word, the laws of economics. If you go pro-growth and the capacity is not there for that growth to happen, you will get some more inflationary pressures. Does the Fed ignore those? That's a possibility. And then, which would obviously cement, if you like, your comment there, Jean. But I think the other thing is, and I know I'm speaking from a very traditional sort of background here, I believe the tariff revenues, which I think will hold. I mean, I think there's no way that the court decision the other day to basically cancel essentially the country tariffs, the reciprocal tariffs, I don't think that will stand. I think the Supreme Court ultimately will overturn that, and they're going to stay in place anyway. But if they don't, that's a whole new ballgame. I don't see the tariff revenues, although they've obviously been quite significant, being anything like enough to curb the rise in the fiscal deficit, unless you get an extraordinary productivity boom. You get some sort of productivity boom from AI, which means the fiscal deficit starts to go down. That would be wonderful if it did. If you got tariffs coming in, you have these big tax cuts, you had the productivity growth in the economy, potentially mainly from AI, and it led the deficit to come down, and eventually the debt GDP situation stabilizes. But my view is that the tariff revenue is not going to be big enough to be more than a drop in the bucket here. And therefore, in the limit, I think there'll be a constraint on these pro-growth policies through A, higher inflation, and B, ultimately, much more over the long term from the fiscal side. So far, and we alluded to bonds already, the bond market isn't worried about that. I have a good friend of mine who immediately when the bond market started to give way in April said, we're heading to 8% bond yields. On 10 years said, let's not get carried away here. It tends to get carried away. We've been, for 10 years, we've been between 4 and 5 since then. And right now we're pushing down towards 4 because the labor market's obviously confirmed now, I think it's been softer than people thought. So I think the bond market's really unclear as to what could happen on the fiscal side, but those are the constraints on those pro-growth policies. And I would be more worried long-term over, is the pro-growth policy of this government going to blow the fiscal deficit out in a way that's, and the debt levels going high, that it is dangerous, as opposed to the Fed, even under a new, under new membership, deciding, okay, inflation's high, but forget it, doesn't matter because we're going for growth.
Geoff, my view is that I see a scenario happening, and I think you're correct. But I think what people are, look, the Fed has all these theoretical things they do, but in the end, it's all about saving the stock market. That's what the Fed has. That's the Fed's mandate, to save the stock market, to save the financial assets. And in this scenario you talk about, you're going to have, and I'd like to hear your theory on this, or maybe both of you, about how this is going to affect around the world, including emerging markets. We're going to enter a period of a steepened yield curve like we've never seen before. Meaning you're going to have the Fed artificially lower rates, which I don't think they should, because, again, given their mandate of keeping the stock market up, it makes no sense to raise it with the stock market at all-time highs. Mm-hmm. You have the stablecoin situation, which is going to buy up and drive down rates to ridiculous levels because of the amount of assets going into stablecoins. It's just going to accelerate. And they're going to be the buyer because no one else. And then you talk about the fiscal deficits, all these things that are not going to be able to lower the 10-year or the 30-year. Those things will continue to probably inch higher. So I don't know how you measure how steep things are. We're going to get maybe the steepest, at some point, the steepest yield curve we've ever seen, where you have rates almost at zero and then 10-year rates at 4.5, 5. It sounds crazy, but what's the implications for the U.S. and then outside the U.S.? How does Brazil or other countries deal with an incredibly steep yield curve in the U.S.?
First of all, it's very good for U.S. banks. I guess we all know that.
They make a fortune. They're going to make a fortune, an absolute fortune.
If I may correct you, trust me, as someone who first came to the US in 1981 when prime rates were 20%, this would not be the steepest yield curve we've ever seen. But nonetheless, it would be a very steep yield curve. Now, I agree with you. While I was at UBS, the guys put out a very interesting report, which I think has become much more standard now. Maybe it was standard then, I don't know. That showed that the reaction function of the Federal Reserve to inflation, to growth, to whatever, the dollar, was much greater to the stock market than anything else. So to a certain extent, even if I wouldn't say their mandate, which would be obviously an informal mandate, would be to save the stock market, I think it's clear that a weak stock market does bother the Fed because of its potential knock-on effect to the economy through reduced wealth effects. Because as we know, the people who are doing well in this economy are the people like us three and all sorts of people who are much, much, much more wealthy than we are. and it's not the people at the lower income scale who are obviously clearly struggling, and they would worry if you saw the Fed would worry for its growth mandate if they saw the stock market go down sharply. Now, before I answer your point about the steeper yield curve, I'm not actually saying, and this may seem to be inconsistent, but I'm not actually saying I'm bearish on US stocks. I'm not really bearish on US stocks. I'm still reasonably fully invested, and not fully invested, but reasonably decently invested in US equities, because I see that the growth story in the US is better than a number of other countries. But and I think that what's going on in the AI space, which I know so little about, my brain has only got so much capacity, and AI is not something that I particularly spent a lot of time learning about. But there could be a substantial investment boom in the next year, 2, 3, 4, 5 years or so, which would support the economy and indeed the stock market, because of course the data, the earnings numbers are still reasonably good. Now, if the Fed cuts rates against that background, which is very likely, I mean, I think you have to, at this point, or at some point anyway, make a distinction between a labor market that's softening and an overall economy that's doing kind of okay. There was a wonderful piece in the FT the other day, which, in fact, I think 2 days ago, which supported your view, Tom. Someone was saying, they shouldn't be cutting rates at all, given the real data. Maybe they should be raising rates. No, that's not going to happen. And you can argue whether they should be cutting rates, but they will cut rates, I think, in 2 weeks' time. But if what you get is these lower interest rates and the economy at the margin is supported, and yet you still have this potential for the budget deficit to go up potentially sharply, and the debt numbers go up potentially sharply, I think you do have a possibility that interest rates in 2 or 3 years could be 2.5%, and bond yields could be north of 5%, which gives you a steeper yield curve. Now, what that means for the rest of the world, and you're seeing it now in Japan, you're seeing it in France, which has now got a higher debt spread over bonds, unless it's changed in the last couple of days, than the Italians have got. We have to redefine the the so-called pigs, I guess, at some point. France having a terrible budget deficit situation with a huge government spending to GDP ratio of over 55%. They've got a real problem there. It's going to lead to higher bond yields around the world as well. And I don't think investing in Europe in this environment is necessarily the answer, but if you were to get this policy mix here and short rates coming out, I think it would push the dollar lower, because it will, I think, still be will be accompanied by a higher fiscal deficit. What happens to the trade deficit is unclear, because it has come down because of the tariffs. We'll just see how much it comes down. But I think all of that will lead to some loss of confidence in the dollar, and the dollar goes lower. And I think EM does quite well against that background. But steeper yield curve, above all, I suppose, benefits U.S. banks for what that's worth.
Yeah, so it seems to me, Geoff, that there's the big debate in the markets is whether sort of American exceptionalism continues, and that's marked by this potential huge productivity boom, and everything Scott Bessent talks about deregulation is going to make the U.S. grow more. Business seems to be buying into that. And then the U.S. continues to be like the least dirty shirt in the laundry bag. Yeah, it's terrible, and but everybody else is much worse. And when you look around the world, I mean, there are plenty of countries that seem on the verge of blowing up, in emerging markets as well as in Europe. And then so the big question is, do you believe in this productivity boom, right? Is AI going to change everything? Is the administration's policies, are they really going to work? Is deregulation is this investment boom really happening? And then if you do believe that, maybe the U.S. is still the place to be, and nothing else will work.
Because if that is the case, obviously the dollar will not go down, and then
No, exactly.
will obviously
that aborts the whole emerging market story,
yes,
right?
precisely, absolutely. That's much more graphically put. You're right, it does. I think what they're doing could work, but I think it could work for reasons that are not what they have put in place to try to make this thing work. What I'm trying to say by that convoluted statement is I think if it does work, it's going to be because of artificial intelligence, leading to an investment boom. It is not going to work because the tariffs are going to be so big in terms of revenues for the US that, you can cut taxes again and again and again. You can go back to the era when tariffs were the major source of government revenues and there was basically no or very little income tax. I just think that's Pollyanna-ish stuff. That's not going to happen. But an investment boom of sorts could well happen. That makes that a possibility. And so what you went from American panic about American markets and panic about the American economic situation in April, May to we're back to exceptionalism, or we could be back to exceptionalism. And I think, that could be the case. I, at the margin, doubt there's going to be a big enough productivity boost in these various industries that benefit from, that are the core of the AI story to offset potential weakness elsewhere. I think the consumer is going to roll over at some point in the US. And so I'm doubtful this will lead to a major GDP expansion, but we'll have to see if that's the case. Now, let me just say this about, everything else is bad, least bad place in the dirty laundry basket or whatever. I think one of the things that does not get enough airtime is generally, with some obvious exceptions, such as Turkey, above all, you have seen extremely good monetary policy in a lot of major emerging markets. So although on the face of it, there could be pressures and some may be about to blow up. And of course, Brazil being a great example with very high real interest rates still, and Brazil facing these high tariffs for entirely political reasons, of course. Yet you could easily see that in the environment where you were to get significantly softer parts of the US economy and a weaker dollar, you could see that some of these emerging markets could have room to reduce interest rates, and that could support their economies. I do like the Brazilian story. I'm very skeptical of the Mexican story because they just have no growth, and they haven't had any growth for a long time. You look at Taiwan. If anybody's going to benefit in EM from the AI thing, it's of course Taiwan. I've looked up the latest data because it's important to have this on hand. TSMC is now over 10% of the EM index. It's nearly twice as big as the next biggest company in the index, for what that's worth, which is Tencent. And Taiwan is the second biggest market, of course, after China. And I think long term, if AI does well, and there's an investment boom in the US, Taiwan will do well. I think Korea is a market that has been under-owned for a period of time. I'm much, much more skeptical about the China story. So my country picks have not been great this year. I'm much more skeptical about the China story because the economy in China is under severe pressure, which they're papering over now and again with a bit of tweaking here, a bit of tweaking there, etc., but not really being very successful in getting the sources of growth switched towards consumer spending. It just isn't really happening. And India, of course, has got smacked with 50% tariffs, which I'm pretty sure are going to come down probably reasonably quickly, would be my bet. You look at South Africa, great monetary policy. You look at Central Europe, which had a blowout year. There are a lot of bad stories in EM, or a few bad stories, but in the event of a further decline in the US dollar, even if it's a modest decline from here, there are plenty of countries with good monetary policies that can reduce interest rates, encourage flows to come in. And I think it would take a very, very big investment boom over a sustained period of time to avoid the lower dollar scenario, because the lower dollar is driven by what are still, in terms of external and internal balances, by internal balances meaning fiscal side, that in the US is still under pressure.
If you like Taiwan, you obviously must have limited concerns about any kind of conflict with China.
Well, you know me, I guess once a strategist, always a strategist. You know, I always reserve the right to change my view next week or something. And really, to be fair, I was answering the question in context of the whole discussion we were having. Do I think China will try to take over Taiwan, succeed in taking over Taiwan in my lifetime, which has probably got 15 years left anyway? Yeah, I think they will. I think they probably will. Is it imminent? I don't know. I mean, I do think that I love geopolitics, by the way. I do think the India, China, North Korea, Russia love fest of the last few days had a lot to do with simply to show that countries, big countries around the world, important countries around the world, are willing, quote unquote, to stand up to Trump, so to speak, even though it's debatable how much they're standing up to Trump, but I guess to a certain extent they all are. I don't think that necessarily means that, however the Russia-Ukraine situation resolves itself, and that seems to be a completely, very, very difficult situation, I don't think it necessarily means that it brings forward China's invasion of Taiwan. I know people say 2027, 2028, I don't know, but right now it's not imminent, and therefore I think if we believe in this AI boom, I think you've got to look at Taiwan as a potentially good place to invest. I had lunch yesterday with a dear friend of mine here in Chapel Hill, who's a professor in a regional planning department who I met through a friend of a friend. Argentine guy actually started to ask me about Argentina. And although this is a few months ago, we've been having lunch for a long time. And he said, I said, well, how do you use AI? You know, do the students just use AI? And you can tell because they all produce the same essays or the same answers to questions. And he said, well, first of all, once somebody uses AI, somebody else will put something in it so that the answer you'll get the next day is different. But what he does with AI is he uses it to help him edit, correct the text that he's written by normal manpower, if you like. So I'm getting off the track, but there's so many uses for this thing, obviously, and the world is so different even to just 5 years ago that I think the boom does have the potential to go quite a long way. I don't see China invading Taiwan just yet, but I think, as I say, in the next 10 years, it's probably going to happen.
Yeah, I mean, as a person who's involved in AI on a daily basis, I think really we're in the very early innings of implementation, right? So today, the spending, there's big spending going on in infrastructure and tools, right? So you've got the big models, people are building these big plants in anticipation. But there was a recent report that came out 2 weeks ago about MIT, which was very negative on AI from the headline. But if you read the report, which I did, most people don't read it anymore, but even if you put it in ChatGPT and it summarized, what it basically told you was that the companies, the large enterprises, right, which are spending this money, are, let's say, going to Copilot and or OpenAI, and they're taking on tools and they're bringing in, okay, let's bring APIs in, let's spend $10 million, $20 million, $30 million, bringing all this stuff in. And what has happened over the last 12 months of this spending is that nothing's happened. It's been a failure in the sense that AI hasn't been able to extract the efficiency gains, and because of the simple reason that the internal IT departments and the internal they don't understand AI. So imagine you take not just ChatGPT, but you decide you want to implement this in the finance department, and you tell your IT people, okay, go out and here's $50 million, go out and spend some tools and bring it in. and it's been a failure. And the opposite is those that have hired, let's say, AI implementers, people that understand AI, and brought them in. They've had much more success. And in a sense, there's less spending, right, than there is on these big tools. So what I think is going to happen is you're going to get going forward, since we're even in the warm-ups before the game has started, we're going to get huge efficiency gains as enterprises turn towards outsourcing and bringing in AI experts who can understand their business and implement it, as opposed to the spending on these massive, big open AI and all this power and all this. So I don't think we're going to get. I think the boom in spending is going to be from the enterprise bringing in implementation, and the efficiency gains are going to be massive. Whereas this spending we've seen is just on, these big plants and all that. I don't think that's going to happen, quite frankly. But anyway,
I wonder if AI is just not going to make the rich a lot richer and the poor a lot poorer and a lot more unemployment. And you hear, I mean, there's so many different opinions on this, but everybody seems to agree that it's going to be a fundamental change in everything. And I read, I think it was a McKinsey report recently on India saying that you could eliminate like 1/3 of the jobs in the Indian IT industry, which is like the most successful and dynamic industry in India. There's a lot of basic stuff being done that AI does extremely well, and much better than workers. So I just don't think we know enough right now. All we know is that there's enormous amounts of investment in hardware, and if that benefits NVIDIA and benefits other hardware suppliers. But the end game of this, maybe it's just the rich getting much richer, and as if that's what we need in in our society.
Two thoughts there. First of all, if what you both say here, and I'm not an expert in all of this by any means, is that it's going to bring that Fed mandate back again, the growth story, because you're going to see some pickup in growth, obviously from the investment side over a sustained basis, however big it is. And yet you're going to find that there's going to be issues at the lower end of the income scale, which is going to impact consumption and also impact unemployment and the employment numbers. I mean, I'm sorry to bring it right back to hopefully something I understand here, is that these labor market numbers recently have been shockingly weak. And in fact, if it wasn't for the AI boom in the background, or maybe enveloping all of us, people would be talking about these being potential recessionary labor market data, even though unemployment's low, but you can still see unemployment go up fairly sharply from here. So that's one thing I would say in response to your comment, Jean, that it's going to make the rich richer and is going to put more challenges ahead of people who are less well off. The other thing two other things from here. Sorry. First of all, you mentioned an important point there, Tom. You mentioned the word power. And I don't understand all this by any means, but the amount of electricity investment that has to go on to power all these AI establishments, one of a better word, is obviously huge. And the other thing to I think show, I mean, I've learned over time, and maybe you guys will disagree with me, but I've learned over time that you don't write about stuff you don't really understand. Or at least if you do, you better do some prep before you do it. And there was a piece in the Financial Times by Rana Faruha, who is one of their economics writers. And she, it was about a week ago, she said, why AI is not going to take my job. She basically wanted to write a piece about something, and this is what the story of the article was. And I asked ChatGPT to do it, and it was terrible because it was clunky and it was, just not what I wanted, blah, blah, blah. But that's where we are today. Presumably, Tom, you're the expert here. It's going to get less clunky as you go forward. And I think it was kind of naive and almost cynical to say, I'm fine. I'll carry on writing my nonsense for a long time, as indeed will I. I mean, if when I post on LinkedIn now, you did this morning, it asked me, do you want ChatGPT to write it for you? I said, no, thanks. I enjoy writing. But, these things are going to get better and better and better. And not everyone is going to do what my buddy UNC professor's doing, which is just to use it for checking. So I think what we're going to have out of all of this is despite areas, Tom, that you're talking about that are perhaps less bullish, you're going to get an economy here where the consumer net is under some amount of pressure because of the lower end. You're getting an investment side which is reasonably strong. You're going to get a government spending side which is going to collapse as far as I'm concerned, or at least be very, very weak. You're going to get a net export position. Who knows what it could be? It could be positive for the economy. But, you're going to have a situation where the Fed's going to have a challenge as to what to do in this environment.
Yeah, I mean, turning it back to emerging markets, Jean made a good point. So economies like India, economies like Brazil, and obviously China, you've got situations where in terms of the enterprise, big business, and even medium-sized business, there's no AI implementation going on. I mean, we're really in the early innings. But I can tell you, because I speak with these folks almost on a daily basis, that it's coming down from the board. It's coming from the CEO. We need to look at this, and essentially the efficiency gains. Let's turn efficiency gains into earnings power. The earnings power of some of these companies is, despite obviously the unfortunate issues with maybe people getting laid off, whatever. The efficiency gains turning into earnings power for some of these companies can be immense, because in Brazil, in India, you still have a lot of these things that go on, operational things that go on with lots of people. There's companies that have way too many people involved in certain departments, which I'm not going to mention, that and they hire lots of interns and lots of people because they have all this fiscal things to fill out, and especially in Brazil, red tape. And this is where AI solves all the problems. So, and sure, there'll be shifting of labor force, but it does lead to potentially, huge efficiency gains, which will turn into earnings power, right? Because you're saving labor, you're shedding labor, and all of a sudden it goes to the bottom line. So it could be a very interesting time, because we could get a lower dollar combined with earnings power coming from some of these companies that could drive these markets. I mean, I'm looking at longer term stuff, and I'm obviously more bullish on it than you two guys are, but that's how I see it.
But it just may increase social conflict as well.
Yeah.
And one thing that struck me is computer science was the major that was recommended to a generation of kids. Do computer science and you're guaranteed to have a good job. That's one of the hardest hit areas. All these kids that got their computer science. There was a great article, I think it was in the journal last week. All these kids got their computer science degree and can't get a job now because AI is doing it. Mm-hmm. So imagine the social consequences of this. We already have this very angry class of young people, and this could just make it a lot worse. So this has nothing to do with emerging markets. We're getting off the subject here.
Well, I think that two things again from me. First of all, it is very interesting how, living in a university town where the university completely dominates the town, and I sing in a choir here, and there's a lot of young people in the choir, and you can just tell that they're very worried about their job prospects, going forward. And that's not just because of AI; it's the way the labor market is right now. We see that from the JOLTS data, etc. But the other thing I was going to say, and back to emerging markets, is one of the reasons I like India long term, and I think you made a good point there, Tom, about the potential labor cost savings there, is back to the old reasons why Jim O'Neill came up with the BRICS all those years ago, is that India's so poor. India's so poor. There's so many people surviving on the land and etc. The upside potential is so huge as long as they can get the economy right. And they've done a decent job on the economy, frankly. And if that could be combined, albeit there would be social tensions because a lot of people would be laid off, if they could combine that with some sort of investment boom as well and a market with a lot of earnings power, you could still see this economy as being essentially one of the best, if not the best economies in the world in terms of growth. And I mean, you know, I like India. It's not been very helpful for me this year, but I think that I think Modi and Trump will patch it up, and I think you'll get lower tariffs eventually. They've got room to reduce interest rates. They're benefiting from lower oil prices, and I think you know, Trump will get used to the fact that they're importing oil from Russia, and I think they're going to continue to do that. I was just doing an interview on Indian TV where someone was saying Trump's not going to push us around. This wasn't me saying that, you know. So, and you've got a situation, of course, where you've got such a low GDP per head level still. You've got institutions in India, some which are corrupt and some which are not. But broadly, you have an institutional structure. So I don't quite know how we got onto this, but that's certainly something which I think is to keep an eye on over the 10 to 20 year period.
Yeah, Geoff, what are your 2 or 3 favorite emerging markets at this time? You know, aside from India.
I do think you've got to look at mainly, unless there's a structural story such as Taiwan, which I think is still something that should be a reasonably core holding right now. I think you've got to look at countries that could be the biggest beneficiaries of lower interest rates and a strong currency, weaker dollar. And therefore, I like Brazil. Brazil's done well this year, although latterly, as we all know, has not done quite so well. And there are inevitably, this is Brazil after all, the country of tomorrow and always will be. We've got, you know, fiscal challenges. I think, as I say, I'm not so keen on Mexico, partly because it's had a very blowout year already, and there's not much growth there. I do like. There are parts, and it hasn't really worked very well. I think there are parts of the ASEAN region which look quite interesting. You've had a political upheaval in Thailand. You've had these demonstrations in Indonesia, but I think the story there continues to be one where, you know, these countries will export more potentially to the US. They might see business from, you know, transitional business, not just through Vietnam, Sri Lanka, and Bangladesh, but potentially through those countries as well. I think the story in Central Europe is harder because you've still got the, you know, the war on their, you know, essentially on their borders. And I think there's a little bit of a loss of general enthusiasm about Europe. And of course, the weaker the dollar is, the stronger the euro goes. That makes it hard for these countries to export. And of course, they're either in the euro or they're not. They're tied or they closely follow the euro. I kind of like, in this environment, I kind of like South Africa, frankly, because I think there's potential there for a better economy going forward. They've got a very good central bank, and although there are political issues as ever, especially structural unemployment, and you've got, you know, 3 classes now instead of having 2 classes, you've now got the poor blacks and the rich blacks and the whites. It's still, I think, a story that is worth looking at, and I don't know. I'd probably leave it there, but I'm pretty skeptical about. I think the outlook for the Indian economy is so much better than the outlook for the Chinese economy. Let me put it that way, because I think China is still not dealt with the property overhang, still invests too much, still has this knee-jerk response to economic issues of trying to put a bit of more investment into the economy. And although I think Trump ultimately will make deals with China, which will help the market, I'm sure, until he rebalances the economy towards consumer spending, I think you're going to see growth potential capped, and ultimately the market will bang up against that ceiling.
Don't you think
Any thoughts on Argentina? Is that a market that you look at?
Well, I do, but of course, it's not an emerging market. The latest attempt to turn Argentina around. I have strong views on Argentina, which is that the electoral cycle is too short. The importance of the midterm elections is too great. So you basically got 2 years to put it right before you start to face the midterms. And Macri was the one before. And, I remember being constructive, thinking, well, it's going to go better now. He's doing the right things. And then, of course, it blew up. And I think what Milei is doing is good, but you cannot build reserves, sort out inflation, stabilize the currency, and get growth going. You can't necessarily get that in 2 years. Stabilize the budget deficit when you've had a history of what you've had in Argentina, and you have a very virulent, anti-right-wing, anti-conservative, quote-unquote, anti-free market, at least having free markets generally in Argentina compared to other countries. You got that big opposition, the Peronist opposition. So I fear for what Milei is going to happen to Milei's party and the right-wing generally in the midterms. And actually, I think at this point in time, you can make a case that, Macri was doing a bit better than Milei is at that time. But so I hate this 4-year presidential term for an emerging market trying to turn itself around, and the midterms are a problem. So I think they got a chance of getting it right, and they got still challenges to go. But he's also, dare I say it, a slightly crazy guy, and you don't know quite what he's going to do. We're going to know much more after October, for sure, to see whether the Congress completely handicaps him, for want of a better word.
So, Geoff, we're about to wrap up here. So I would like to get your opinion, because there's a lot of, especially the last couple of days, a lot of talk about the UK and this arresting of this comedian a couple of days ago with guys with guns off a plane. I mean, free speech seems to be under attack in the UK. It's really crazy, and this is obviously lighting a fire under Nigel Farage and his party. And I heard someone say if there was an election today, he would win by a landslide. What's going on in the UK? You have a house there now. You just bought a place. So as we wrap things up, give us your overview of the UK, and is it as crazy as a lot of us think it's going?
Also, one of Boris's ministers, Nadine Dorries, has just resigned the Conservative Party and gone over to Reform UK. I think, as with everything, these stories are magnified into such situations. Everything's going wrong, and the place is lawless or whatever. There's a lot of there's a great article in the Economist a couple of weeks ago about how many cell phones are stolen off the streets of London, and cars are stolen and recycled to other parts of the world. Hang on to your cell phone if you're in London. 40% of the cell phone thefts in Europe are in the UK. And yet, if you go over there, it all seems to work pretty well. I think these are isolated situations. Now, does the UK have a fiscal problem? Enormous fiscal problem. Arguably, at the moment, worse than the US's fiscal problem, because you've not had this. You've not had the room to do the big, beautiful bill or something equivalent to it to try to support growth going forward, let alone the fact that the UK is not obviously a central part of this AI boom, at least it's not yet. I think what they do over there, which is have 2 budgets a year, which means 2 official goes at this whole estimating where the budget deficit is going, where the economy is going, is really just ridiculous. It shouldn't be run that way. I think Keir Starmer he's a bit like John Major, but on the left wing. He's a grey man who hasn't really I think, got to grips with what the economy needs to do or needs to be done for the economy overall. So for me, the security side, so to speak, or the crime side is something to be concerned about. The problem with saying that Farage would win is, of course, the way it works in the UK with the first past the post system. Although the Reform UK is well in the lead, it's anti-immigration, that's the key thing. Could they put enough candidates out across the board in all these constituencies, of which there's 600 plus, to actually win a majority remains to be seen. You can have a bigger percentage of the popular vote without necessarily, winning the seats. But right now, both Labour and Conservative are in a bad shape, I think. And so if there were an election day, you may well be right. And yet in the UK, and I'm wandering all over the place here, but in the UK, there is no doubt that some increase again, or re-increase, for want of a better word, engagement with Europe is something that is very important, whether it's done politically or in terms of trade and economics. There is a lot of buyer's remorse about being outside, about Brexit, being outside the EU. Now, this means to say we're going to have a vote anytime soon about going back in. So there's a lot of things going on, but the country, you go there, it actually seems pretty stable, not that threatening, Big problem in the UK is they have no fiscal room whatsoever because productivity is terrible, and so they don't have enough growth. Inflation's too high, so what can the Bank of England do from here? Monetary fiscal policy challenges are huge, and that's going to limit the growth story going forward. But the country will function because the country always does. And yet, we should have another longer conversation about, Farage and Brexit, the UK Reform Party down the road. But trust me, it really does work. And everybody's there, I was there in the summer. JD Vance was there.
I was there.
You were there. Kardashian, Ellen DeGeneres. People say, you're going to move there permanently? I said, no, of course not. Why would I do that? We want to go there a lot. I can't move there permanently because you're probably going to chop this out. I don't blame you. Because of healthcare, etc. But anyway, I think the headline.
I think most people don't care if their country goes broke. That doesn't bother me.
Yeah, quite. Anyway.
I spent a month in France this summer. I don't think anybody cares that the country's going broke.
No, I mean you go on the London Tube, and on the big lines, the Central Line in particular, and a train arrives every 2 minutes, and it's full. The biggest problem they've got in the UK in terms of transportation is that they privatized British Rail, and they're going to probably renationalize it, which they should do. Anyway, separate conversation.
Well, Geoff, listen, it was amazing, as always, to chat with you and hear your views on EM for sure. And obviously, sneak one in on the UK. Yeah. So we'd like to thank you again for being the first guest. and I just figured out we had forgotten the name of the podcast, so it's EM Unlocked.
All right.
How about that, Sean? EM Unlocked. Well, Geoff, we'll have to have you on again when some big event happens. Everything blows up. Yep. But again, thanks again, and really appreciate it.
Okay, take care. Thanks, guys.
That was great, Geoff. Thanks a lot.
Thanks. Bye.